Incredibly grateful to be here today. As Jeanette alluded to, we just reconnected after knowing each other for many, many years. It was good to sync up again, and again the opportunity to present today is something that I relish and am grateful on this Saturday that you guys are taking the effort to grow as people, to grow as traders with all these presentations, with Tony, with Hema. It's great and an incredible honor to be running anchor leg to this triumvirate of traders today. The class I'm teaching today is factoring market positioning to find great risk to reward trades, and I think this is something that is not talked about a whole lot in the trading education community, and something that has both a quantitative and qualitative aspect. So I'm really excited about pushing the envelope here and in the information that we can share today. As every presentation, this is the risk disclaimer. The presentation was created for informational, educational, and entertainment purposes only. The information here is contained as is and not guaranteed to be complete or current. No representations being made. The use of the strategy will make money, etc., etc. And obviously, there's a lot of risk associated with trading. We all know that, but you can never say that enough. And of course, and this is very important for my particular circumstance, past performance of any trading system or methodology is not necessarily indicative of future results. And why does that apply to me and to my situation in particular? You'll know in about 2 slides, all right? So a little bit about me. Jeanette talked about our history. And first and foremost, I am a cross-asset class trader. I make my living 100% of how I support myself, 100% comes from my trading P&L. 100% comes from my trading P&L, all right? I'm the author of The Global Macro Edge, Maximize and Return Punitive Risk. This is my personal magnum opus and involved a number of contributing authors that took 5 years to construct this book. Began writing this in 2011, finished in 2016, and every dollar we've made from this book has gone towards charities that train and place service dogs with military veterans. All right, this is a cause that I'm incredibly passionate about. I'm the owner of a golden retriever, Delta. You traders out there will get that. I'm a U.S. Marine Corps veteran. I joined the Marine Corps right out of high school in 1993, and I stayed in for almost 9 years to 2002. I love foreign languages. I lived in Japan for 4 years. I majored in Mandarin Chinese and lived in Beijing for 2 summers. My wife is from Brazil. And having lived in New York City for 7 years and grown up in the Bay Area and in California, grew up around a lot of in the Latin community, both California Latin community and the New York Latin community, which is actually a little bit different, but just love Latin culture and love foreign languages. And I'm based here in Las Vegas, Nevada, a town which truly has an appreciation for the art of speculating. I talked a little bit about how passionate I am about veterans' causes. What you see right here is us taking $3,000 and donating it to Rebuilding Warriors. Rebuilding Warriors is a great charity run by Jeff Anderson, and this is my dog Delta right there. The first donation we did to Rebuilding Warriors earlier than that was from a year before that, was back in June of 2016. This tweet on the left here is from Memorial Day when we tweeted this out from that donation. This is Buddy, a service dog. He went to a Army Apache helicopter pilot, and that's something that, obviously very proud of to see the impact of these dogs. And then on the right here, I tweeted this out again back in February, right before the New York Traders Expo. We went there. This was a $3,000 donation that went to Red, White, and Blue Dog Tags. They are a local Las Vegas charity. Milana, that's Milana right there. She runs that charity. This represented about 20% of their annual budget. And again, sitting there with Delta, and they actually take rescue dogs and donate them and train them up. She's a specialist and is really good at training dogs to become, to help with PTSD and anxiety and traumatic disorders, etc., and gives them to veterans here in the state of Nevada. So a lot of good cause I'm very passionate about, and it's where the profits from this book have gone and something we're raising awareness for. All right. When I talked earlier about past performance not being an indication of future results, what I'm about to share with you was a material contribution into the performance that I have right now. One of the key points of the Global Macro Edge is that I went out and hired Mike Coglianese from Mike Coglianese CPA. I encourage all of you to Google him. He is one of the most well-respected CPAs in the futures industry. He's based out of Bloomingdale and Chicago, Illinois. He has 2 offices, and he and his team took about 3 months to do an audit or to verify my personal track record. A track record where, beginning in January of 2010 ending in December of 2015, I took a $100,000 risk budget, okay, and how do I, whoops, this is not, I'm trying to get this so it makes up the whole slide here. Let's see.
Maybe in that display
how do I make this the whole slide on the page? How do I do that?
I don't know how you opened it up. I usually just go from beginning, and that's what you did. So it must be in your display settings. See that display settings drop down? Okay, yeah, close that out.
Okay.
Whatever that thing, close that out and go back to PowerPoint.
Okay.
Go there and then go from current slide.
Gotcha.
From current slide. And then,
yeah, it's,
okay, so it's in your, what, presentation view, presenter view, and slideshow. Click that and see what happens. That's swap presenter view, and that, click that.
Boom.
Boom.
Okay,
there you go, baby. You live, baby, live. There you go.
You know what? I have 8 monitors here, and the real big slide was on another monitor, which is not the main default view. So my sincere apologies for those who could not see those. Yeah, so that this is much better. Thank you, Jeanette, for doing the magic there and catching me, saving me from myself. All right. Okay.
Always, no problem.
Yeah. So listen, talking about the performance, which this presentation is going to outline what, you know, a material part of generating this performance, at least delve into. In January of 2010, I had a $100,000 account, all right, $100,000 risk budget. And I said, all right, I'm willing to risk 100 large, okay, using what I know and just make this happen, okay. Over the next 6 years, I took that $100,000 and generated $3.1 million in P&L, net of commissions, all right, in P&L in my futures account, all right. The story of that is outlined in Chapter 3 of the Global Macro Edge. You can see that on Amazon. You can go to Amazon, and there's a look inside feature in the Kindle version. You can see it much more in depth. You can read the performance, the descriptive statistics of you know, my correlation with the S&P, etc., which, by the way, was negligible, almost it was literally nothing to the S&P. So this wasn't made from being long the S&P 500 over 6 years. This was made from being totally non-correlated to the S&P 500 and generating it independent of whatever the market did. You can see here, just year by year, $206,000 in 2010 I made, month by month, $455,000 in 2011, $700,000 in 2012, made over $1 million in 2013. 2014 was tough, but this is the real world, made 204. In 2015, popped 465, so back on the uptick again. This is all real, this is all audited, this is all verified, all right? Here is the Mike Coglianese letter that appears in the Global Macro Edge. Again, in the last comment, if you understand accountant speak, in our opinion, management's assertion that John F. Netto complied with the aforementioned requirements during the period from January 10th to December 31st is fairly stated in all material respects. That CPA talk for, he's legit. So, what allowed me to do this, all right? What allowed me to make this happen? Well, for starters, I cannot emphasize this enough. Trading is really difficult. It's really, really hard. It's incredibly difficult. I battle myself. In the process of generating those returns I just showed you, I went through periods of drawdown. I went through periods of underperformance, of not generating months at a time, in fact, of being down, of being flat. And so I can't emphasize enough that with all my skills, with all my technology, with all my network, this is a very difficult game. But it is achievable. It is doable. I believe that. Okay, I've done that. I can show you that, and I believe it's achievable for just about anyone. Maybe not everyone, but just about anyone can see improvement in their trading, in their investment process. A little bit about me. I'm not a buy green, sell red signal type of guy. I'm not that simple. I just can't. I never found. I could never generate consistent P&L buying a blue or buying a green and selling a red. It just mixed results my entire career when that's all I had to work on. My successes come from thousands of hours of work, persistence, and a willingness to adapt. Hence the name The Protean Trader, which is my company. And Protean is based off the Greek god Proteus, and it means highly versatile, easily adaptable, and able to take on many shapes and forms. It's my willingness to adapt, which in a market which is inherently adaptable, that has been a big key to my success. My learning process is analogous to learning a foreign language. Surprise, surprise. This takes time, and it's done incrementally. If you want a quick fix, if you want something that's going to pay you to where you'll be profitably trading or have a winning trade tomorrow, honestly, enjoy the rest of your Saturday. This is not that presentation. If you want a presentation where you can begin to improve your winning percentage incrementally so that you can make the transition, if you're not already as a professional trader, then stick around. I believe this presentation will raise your market IQ and give you a process that can deliver value for years to come. So are you willing to invest in yourself? That's the question. The goals of this presentation, okay? I want to give you a background of what helped me break through. All right, I discussed some of that already. An explanation of market positioning, which is a key factor in that. Then I'm going to talk about in this presentation the process, both from a quantitative perspective and a qualitative perspective to integrate a market positioning into your trading. All right? So my story. For those of you that read my book, One Shot, One Kill Trading, came out in early 2005. Wrote it for 2002 to 2004. Took 3 years to write that thing, and it was, it was a chore. It's a book that goes over a lot of Fibonacci, a lot of technicals, and it's a very solid technical trading book, all right? But despite this, while I was always a profitable trader, I can never make the life-changing returns, okay? I can never, I generate, I grind, you know what I mean? But in terms of those big paydays, they just didn't come at the frequency that I needed to really have a lifestyle change, okay? So there were 5 things that changed that, okay? The first thing was incorporating the macro narrative, understanding what the story was behind the price action, all right? And I don't mean the story that you hear on financial news media after the price action happens and someone needs to rationalize why the market was up or why the market was down. I mean the real narrative, the real reason what was pushing big money around, what was their rationale, all right? The second thing, which I discuss in Chapter 19 of the Global Macro Edge, is how I built an intuition infrastructure, along with Chapter 8 as well. So Chapter 8 and Chapter 19 of the Global Macro Edge, an incredibly comprehensive book, I talk about how I built an intuition infrastructure. The third thing, and this is enormous, all right, was understanding the relationship between market regimes and market strategies. Hema just crushed her presentation on the last hour. She absolutely crushed her presentation. And one of the things that she was highlighting there, and this is why I love, and why I have a hard time staying on script, because the market doesn't have a script. I don't have a script, okay? So in Hema's presentation, I'm going to go back to that for an hour and why I think her course is a great value. She's highlighting a number of mean reverting trades, okay? If you run any kind of back test on the S&P 500 with a trend following system or with a mean reversion system, the mean reversion system has destroyed that. Now, is that by fluke? Absolutely not. There were a number of aspects going on in the S&P, i.e. compressed volatility, central bank accommodation, a weak dollar. These are factors that have contributed to a central bank put on the downside, but with GDP growth at 2%, make the upside very difficult. So what happens in that kind of market? You tend to get strategies that trade in a very range-bound or technical dynamic. Low volatility, option buyers tend to struggle, trend followers tend to struggle, and it means that strategies like Hema's tend to do very well. You look at momentum when it fades, when it dies. You sell near tops, waiting for your sell triggers. You buy near bottoms, waiting for your buy triggers. And those strategies do very well because the regime is conducive to that, okay? Whereas if you have a market that's going through a reprice, those strategies will struggle at a much higher level, all right? So when you know the market regime, you can take a viable technical trading strategy, overlay it on top of that, and put yourself in a much better chance to win. That, at its essence, is the global macro edge, okay? The fourth thing is I use market position to scale up or scale down my exposure to trades, like I just talked about in the previous example. And the last thing is understand there is no silver bullet to trading success. People, this business is a grind. It is hard. I'm telling you, I have one of the best P&Ls of all the traders I know, and I fight this every day. Every day I'm making decisions. Every day I'm having losing trades, all right? But I still support myself from my P&L because I get it is a numbers game. And so anything you can do to add even the most incremental edge to your numbers is going to make a huge difference when compounded in the future. Y'all with me so far? Good. So what is market positioning? Market positioning by definition, is the net exposure of a particular market based on expectations of a future event, meaning does the market think things are going to go well, or does the market think things are going to go poorly? The market at its core is a discount mechanism. Why is market positioning important? It can determine the viability of a technical setup. It can enhance or detract from risk-reward ratios, kind of like I just talked about. It presents independent opportunities to trade tactically, and I'm going to get into this a little bit later. And this is something that is covered extensively in Chapter 18 of the Global Macro Wedge, and I titled this chapter, Quantifying and Visualizing Market Positioning. Okay? So again, 4 factors. It can help determine the viability of a technical setup. So if you have market positioning in your favor, that technical setup is more likely to succeed. Okay? It can enhance or detract from those risk ratios, sort of feeding on bullet point 1. It presents independent opportunities to trade tactically. So again, if the market is long a stock, you can maybe play that, and I'll get into that. And it's also covered in Chapter 18 of the Global Macro Wedge. So you get a sense already, the Global Macro Wedge is a pretty comprehensive book. 23 chapters, 600 pages. A lot is covered in there, and a lot of original content. A ton of meat is on that bone. So how do I measure it? This term market position, I've given you a definition. It can be kind of a nebulous concept. Well, the first factor is what I call the market position measurement. And I'm going to show you quantitatively how to actually measure market positioning here in this presentation. The second factor is the impact ratio. And impact is, and that's how I measure just likely where a market is likely to move based on the outcome of certain events. So how do I measure market positioning? Here's a little more color on that, or what the MPM is. The MPM is the discount or premium the market is trading at based on the implied outcome of a future event or series of events. In example 1, we saw Tony give an example of the euro in her first presentation. I'm going to follow up with that same with another euro example. All right, the euro USD can be traded at a 75 tick or 40 basis point discount based on the perception of the FOMC will come out with a hawkish statement. The second example is that the 5-year Treasury note can be traded at a 2-handle or 15 basis point premium based on the perception the Trump administration will not get any tax plan passed. So there's 2 examples here. One is one market is trading at a discount based on market positioning. The second market is trading at a premium based on market positioning. Let me elaborate. What does it mean when I say trading at a discount? Well, in example 1, all right, the euro can be traded at a 75 tick or 40 basis point discount based on the perception that the FOMC will come out with a hawkish statement. So what does that mean? So the euro is trading at 119. If the perception about the Fed wasn't so hawkish, the euro might be trading at 119.75. So what do I mean by that? Well, let's say that there's been a lot of Fed speakers out there talking about the economy, talking about interest rates, talking about inflation, and they sound generally upbeat. And that upbeat rhetoric tends to lead the market to believe that the Fed, if they're not going to hike, may hike or at least continue this hawkish rhetoric, okay? So as a result of that, and as a result of the chances of a hike, the market will actually, put pressure on the euro USD because that a hawkish Fed means a stronger dollar, okay? And as a result of that, there's about a 75 tick or 75 tick discount priced into the euro USD. Now, if the FOMC doesn't come out with a hawkish statement, the euro USD could effectively rally 75 ticks, erasing that discount on a reprice higher. Many people get into positions and don't understand that there's a discount or premium there, okay? So that's an example of a discount, that Fed example, where the Fed is hawkish, and that's putting a bit of a discount into the euro USD cross, all right? The next example, trading at a premium, okay? So what does that mean, trading at a premium? Well, let's flip the script the other side, okay? The euro USD can be traded at 150 tick or 80 basis point premium based on the perception the Trump administration will not get any tax plan passed. Spot euro is at 120.50. If there actually was a perception the Trump tax plan was going to be passed, which would be great for the U.S. economy, in a reality, a big tax reform would probably put more pressure on the Fed to hike rates. The euro would actually be weaker against the dollar, down at 119. Now, these are very vanilla examples. I'm giving you a very simple example for the case of this condensed presentation and these can get a little more dynamic, but for the sake of understanding what a discount is and how a premium is priced into these markets, I think this suffices. So if for some reason the Trump tax plan doesn't go through, which happened to be a big topic this week, the Euro USD, you know what I mean, can sell down. I'm sorry, in this case, could rally, and that 150 tick would be erased. They would erase that premium, all right? So that's the rub there. So how do I measure the potential effects of the impact of these things? One is the impact ratio, all right? It's one of many unit of risk ratios that I have in chapter 5 of the book called Unit of Risk Ratios. I talk about max adverse excursion versus max favorable excursion, talk about the Netto number, which is my lead unit of risk ratio, but all of these unit of risk ratios help us contextualize market performance, okay? And while I can't get into all of them today, the impact ratio is the one that does apply to how to measure a market will react to market positioning. So I'm going to go back to my performance again, all right, to demonstrate this first trade example. In April of 2015, I made $97,900, almost $98,000 in April of 2015, okay? 47,000 of that was made in a 48-hour period on the first week of the month, and it lasted around a U.S. non-farm payrolls number, okay? So half of my P&L, close to 47 grand, was made in a 48-hour period, and these are all verified returns from Mike Cogley and Nice, okay? So let me talk a little bit more about that trade, okay? Coming into this trade, all right, I went ahead and based on my market position analysis and, of course, some other factors as well, but largely based on the skew of the discount that the euro was trading at, okay, I went ahead and got into the euro around the 107.80 to 108 level, all right? In the next 48 hours, we had a big beat in non-farm payrolls, which sent the euro rocketing close to 120 pips, okay, 120 ticks higher on that euro, that IMM contract, all right? This was largely determined by my understanding of market positioning at that time. The next example, okay, and this is of a 2-year treasury, all right? And this relates to this year, March 15, 2015, okay? The 2-year treasury had a huge discount coming in to this market, okay? And I put up a chart of the 5-year treasury market, and what had happened leading up into March of 2015 of this year, fixed income, both the 2-year treasury and the 5-year treasury, were under tremendous pressure, okay? There was a perception that the Fed was getting hawkish. We'd had some hot inflationary data with the February number that led the people to think that the Fed was going to come out and actually hike interest rates, potentially in March, or at least gain a much more hawkish rhetoric. And sure enough, the Fed did come out and hike interest rates in March. And so as a result of that, given the hawkish rhetoric, the 2-year treasury was trading at a big MPM discount, or a big market positioning measurement discount. And so going into this trade, we can just see the kind of reaction that when the Fed comes out with a very dovish statement, people were expecting a more hawkish statement, and this was the reaction, this instant reprice, which offered tremendous risk-reward potential. So how do I determine this? It comes from the impact ratio, and that helps me determine my overall market position measurement. All right, so those two things, the impact ratio and market position measurement. So let's first talk about my MPM model as it pertains to that euro trade. All right, the first thing we have to do is recognize that this is a game of probabilities, okay? And as a game of probabilities, it's our job to be able to create those probabilities. And so for the euro trade example, the first thing I did was price out, okay, the survey on the street right now is 244,000 jobs, okay? Meaning that most people think that the survey will come out between 234 and 256, all right? And what are the actual chances of that happening, okay? About 24% of the people out there think that there'll be a modest beat, and 12% of the people think there'll be a big beat. On the other hand, there's a 24% chance there'll be a modest miss, and then a 12% chance there's a big miss. So this is very simple mathematically, all right? And this is something that I'm going to get into in terms of how to compute this in just a few slides, all right? So I simply take these probabilities, okay, and I say, all right, if there's a big beat, okay, what's going to happen to the Euro USD, all right? It's probably going to be down about 80 ticks if there's a huge beat on non-farm payrolls. Fair enough. What happens if there's a modest beat? Well, if there's a modest beat, it'll probably be down about 10 ticks, okay? And it's important that I'm establishing this price range based on what my expectations are. Well, what happens if the number comes in line? Well, if the number comes in line, I think there'll probably be about a 35-tick rally in the Euro USD. What if there's actually a modest miss, given that most people are actually pretty positive on this report and people think that it's going to come in really hot? There'll probably be a 60-tick rally in the Euro USD. And heaven forbid, what would happen if there's a big miss? Well, there might be a 145-tick rally in the Euro USD. Well, guess what, everyone? If there's a big beat, the Euro's only going to sell down 80 ticks. But if there's a big miss, the Euro's going to rally 145 ticks. What if the number's just in line? Well, if the number's in line, it still rallies 35 ticks. And if there's a modest miss, it rallies 60 ticks, at least based on my impression, my perception, my modeling. But if there's only a modest beat, it only sells down 10 ticks. Now, you want to talk about a risk-to-reward ratio? So what I do with the MPM model, I compute all of these, and this is very simple, a very simple probability model. This honestly can be done on the back of a napkin. It's that simple, all right? I simply multiply the numbers. So I take 0.12, meaning a 12% chance of an 80-tick loss. I add that to a 24% chance of a 10-tick loss. Whoops. I add that to a 24% chance of a 10-tick loss. I add it to a 28% chance of a 35-tick loss, and so on and so forth. And what I come out to is 29.6 ticks of positive premium, meaning if I ran this scenario 100 times, I on average would make 29.6 ticks of this scenario. So a lot of people that talk about quantitative analysis, and it seems like this big voodoo subject, it's not so voodoo. This is clearly some very basic, quantitative analysis, but this incorporates my MPM model math and I go and compute a final market positioning measurement. And my final market positioning measurement says, dude, if everything else is equal, you're going to make 30 ticks by being long the euro, all right? But I'm not thinking about 30 ticks. I'm a little more greedy than that. I'm a little more hungry than that. So fair enough. So now I've explained how to measure MSN. Now the second factor I'm going to talk about is the impact ratio. And impact stands for market price action, all right? I, over a 4-year time period, developed a proprietary software called Impact. And what that helps me do is synthesize breaking news events and manage my positions. So at the heart of it, I'm a click trader, but I also use automation from Excel spreadsheets, from Visual Basic, from alerts on my computer screen, doing historical back tests. There's a lot of things out there that we can use. You don't need to be a computer programmer, but you can use automation technology to help identify opportunities. And so what I do is I incorporate the impact ratio, along with the MPP into my software. Okay, and what it does is the impact ratio projects the number of risk multiples an individual market may move. One of the other unit of risk ratios out there is called the Roni ratio, and what it measures is, okay, if the S&P is up 8 points today, it's up 1 risk multiple. If the S&P is up 16 points today, it's up 2 risk multiples. If it's down 8 points, it's down a risk multiple, or it's a de facto standard deviation measurement. So what the impact ratio does is I take a number of aspects and say, okay, how many standard deviations will the market move based on these various scenarios, whether they be breaking news events like a tax plan, or whether they be more structured news events like a central bank announcement or a big jobs report, or some piece of inflation data, or an Apple earnings announcement, all right? All of this can be measured, okay? And when you incorporate these measurements into what you do, I believe you increase your edge, and that increase in edge makes a profound difference over a long period of time. So this is how the impact ratio works. Going back to that FOMC example from a few slides ago where the Fed came out and was dovish. If the Fed was dovish, okay, the impact ratio can be up 2 risk multiples. If it's modest, it can be up 0.4 risk multiples. If it's neutral, it can be down 0.3 of a risk multiple to up 0.3 of a risk multiple. If it's modestly hawkish, treasuries will sell because if the Fed is hawkish, fixed income tends to sell off. And it's very hawkish, it could sell off even more, okay? And so this is at the very basic level how I construct the impact ratio to do this. And I get there's a lot of information I'm throwing at you guys here, but this is what really makes a difference. If you want to understand how I took a $100,000 account and generated $3.1 million in P&L, $3.1 million in P&L, you need to understand how to incorporate market positioning. I don't think those returns I would not have achieved them without understanding market positioning to the level and granularity that I do. So what are the factors in developing MPM and the impact ratio? There are a lot of them, okay? The macro narrative, all right, what I read and who I talk to. The significance of that event, all right, well, how important is this event that's about to happen? Things like whisper numbers. Well, you know, the Fed may be, you know, formally the Fed may be neutral, but what's the market or the street really expecting? What's the whisper number around that event? What about relative value trades? Like maybe, you know, how is U.S. fixed income performing to maybe European fixed income? And the relative strength of those asset classes. That also plays a factor in the impact ratio, okay? Sentiment indexes, key technical levels. Is the market able to break out? Is it able to hold support? These are all factors. Risk reversals. I'll explain those later. That deals with the price of a call and a put of a 25 delta. Can't get into that now. The commitment of traders reports, option open interest, social media, calendar events. What are earnings? Are they generally stronger and upbeat, or are they generally more downtrodden? Government. Is there a political election like we saw in 2016 that was dominated by political elections? And then idiosyncratic market variables. What unique aspects are in the market right now that can influence these things? So before I take questions, all right, I told you that I'm a quick anchor leg here, okay? But before I take questions, because I'm expecting a lot of Q&A, because what I've gone over definitely has some meat to it and definitely needs to be further expounded upon. But let me talk about a new course I put together which really elaborates on what I just mentioned, which was so critical in generating my P&L. The course is called Profiting from Market Positioning, and it's pretty freaking epic. In this course, I'm going to help you identify which positions in your portfolio may be vulnerable, which positions are trading at a discount. If you knew that your position was trading at a premium, and if even news comes out that's not bad or not good, but that could still lead to a sell-off, you'd want to know that because it helps you manage your position. Also, I'm going to teach you how you can use market positioning to determine when to let winners run and when to take profits quickly. Also, I'm going to show you how to use, I built this course to help you integrate that into your option strategies to create great risk to reward trades. If you understand that a market is trading at a heavy discount, okay, then buying call options, okay, buying call options when the market trades at a discount can generate tremendous asymmetrical or huge great risk to reward trades. You can risk one and make 5, make 7, make 10, okay? If the event even just comes in line, okay, on the other side, if a market's trading at a premium, meaning a lot of good news is already priced in, how you can use options to define your risk and play the short side and generate great risk-reward ratios. Maybe risk 1 to make 3 or 4 or 5 or 7, again, based on your understanding of market positioning. You're also going to learn, as I talked about earlier, all those things. I'm going to share with you what I read. Specific articles I read, specific things, how I read those articles, okay, what I'm trying to gather out of those articles, okay, trading news. I'm going to walk through, as Chapter 18 in the Global Macro Edge walks through, how I select events. What are the criteria I use to grade those events? Why would this Fed meeting be important, yet another Fed meeting not be important? Do you know the difference between Fed meetings? Do you know the difference between earnings calls? Do you know the difference between why this job report matters? What about this job report matters? Why does the inflation data matter? What event may be happening in Canada, or what comment about European parliamentary elections matters? These are all things that you need to understand if you're going to incorporate market positioning. I'm also going to teach you, based on those scores, how to identify across a range of asset classes what to look after. Listen, nobody said this is easy, but if you can tell here by following this process, you can make this happen. I'm going to teach you about sentiment indexes, surveys, and spreads. I will teach you, as I just did, on a more step-by-step basis, how to actually calculate and utilize MPM, how to calculate the impact ratio, okay? And then finally, I'm going to walk through a step-by-step strategy for trading big events. And as you can imagine with these things, there's a lot more also I'm going to put in there as well, okay? So I've really designed this course so that you can apply it and incorporate it into your trading process. And ultimately, guys, I'm a big process person, but this comes down to one thing. And I'm going to show you how I achieved, with market positioning, this audited performance. Again, go to Amazon.com. Go to the Look Inside feature. Read the statistics. Read the audit report that Mike Coglini's prepared. I took a $100,000 risk budget over 6 years and generated $3.13 million in P&L after commissions, okay? I'm not sure, but before I invested in anything, I'd want to know that the person used the strategy and generated consistent, substantial P&L. I'm going to show you a key component of how I did that. And then ultimately, like I'm saying, I've used every dollar profit from this book to donate to veterans. I spent 9 years in the Marine Corps. It was one of the most profound experiences of my life. Okay? I would not have the discipline who I have. I would not have the character of who I am today unless it was the Marine Corps. And my dog Delta has also had a huge impact on my life. She's helped me through some very rough times. And as a way, to whom much is given, much is expected. And it's time to look after our veterans, everyone. So here's the metrics on the course, all right? Profit from market positioning course. It's $297, and the first 23 orders received this book before October 11th. I have 23 books in my house right now. I am the only distributor of this book. If you go to Amazon.com right now and just do your own due diligence, okay, you will see on Amazon that this book has 23 reviews. Jeanette, if you can pipe in here. How many 4-star reviews does this book have?
I mean, it's all 5-star, isn't it?
It's all 5. It's all 5. Hey, Jeanette, how many 3-star reviews does this book have? How many 2-star reviews does this book have?
0.
How many 1-star reviews does this book have?
None, 0, all 5. I looked. I checked. When you said that, I was like, whatever. That's a big book. But I went and looked and all 5s, all 5s. You did it,
Hey,
John.
here's another thing. And so people say, okay, fine. The reviews are the reviews. There's not even a 4-star review. Fine. But I'm a big believer that the market talks. Go to Amazon.com right now, and of all the books we've sold, okay, how many used books of this book can you buy right now? How many used books are available at the Global Macro Edge for less than $149? And then compare that to any other book you've bought in the past and see how many used books are available of that book and what the price of that is. The book's been out for 11 months. There is not one used book available of the Global Macro Edge of all the books we've sold. So there's not even a 4-star review. There's not even a used book available for you to find. It's 600 pages. And the reviews, they're not like 2-sentence, you got to have this in your freaking repertoire. They're like heartfelt stories of money managers, portfolio people, work-at-home moms, okay? This book is so big. When my daughter was born 11 months ago, I put her on top of this book and took a picture of it. You can find it on my Twitter feed, on my photos on Twitter, okay? And this took me 3,000 hours to write. All right, so you're getting this book as a primer for this course, but you need to order the next 60 minutes because I only have 23 books in my house right now. Now, you'll still get the book, but I can't guarantee you'll have it in time for the first course session on October 11th. You order it today, you'll probably have this. I will get this out today before noon here on the West Coast. I'm in Las Vegas. So the last postal shipment, I got to get to the post office by noon. If you order now, okay, I can have this thing with my wife. We'll pack these 23 books up in the next 2 hours. We'll mail them out. You'll have this thing probably by Tuesday or Wednesday, okay? If you don't order the next 60 minutes, we won't be able to get it out. Sunday is obviously not a postal day. You have to wait Monday. It'll go out with Monday shipment at noon. You'll probably get it by Friday or Saturday, okay, the way that cutoff works. So you have to order now to get this thing by Tuesday or Wednesday. You also get in this course a signed copy of my book. You also get One Shot, One Kill Trading, which again I mentioned is a very solid technical trading book. So you get all of my technical methods in One Shot, One Kill Trading, and you get a signed hard copy of the Global Macro Edge. Then, of course, you get the live course where I talked about all those things that are mentioned over 2 sessions. One, Wednesday, October 11th from 7 to 8 p.m. Eastern Time because I'm a trader. Can't do it during the trading day. And Wednesday, November 15th from 7 to 8 p.m. Eastern Time. So that's my course. I want to open up to questions. Jeanette, I love questions. I love impromptu. Fire away.
All right, can you see the questions? David is saying, what contributed to the July 2013 P&L? I'm not sure. I'm not sure.
Jay, great question. Jay, he asked about the July 2013 P&L.
I guess, yeah.
Yeah, no, great question. So July 2013, can I toggle back here? Jeanette, is it okay if I go back to the slide just to kind of, so we have context? So
yeah,
in July 2013, I made close to $250,000. I'll never forget this month, single biggest month of my career for my personal account. And this was another big market positioning month. In May of that year, the Fed had come out, Ben Bernanke had come out and talked about that they were going to go, incorporate, well, in the previous December of 2012, the Fed talked about that they were going to go to a more data dependency model. But in May of 2013, Ben Bernanke came out and talked about tapering, that they'd begin to taper their purchases of long-term assets. And what that began to do is cause a shift in the market's perception that the data that came out was actually going to begin to matter more. So as a result of that, portfolio managers that were long duration or long bonds and people that were short the dollar would have to rebalance their portfolios. And they did that over the next 6 weeks. And the creme de la creme of that event was a non-farm payroll number that happened in the first week of July. And I actually presented on this at the Traders Expo earlier in February on this specific trade, how I did that. And a combination of my intuition infrastructure and understanding of just how long duration the market was, and they still had not done a total reprice yet, helped me trade short for a number of reasons over that previous week. Trade short duration, trade short gold, trade short the yen, and really, amass a pretty big score. But market position was a material factor in that. Just understanding how portfolio managers were, because I not only was short fixed income, but then I pressed my shorts, incorporating a number of metrics in that. Next question.
Does the book address, Dave is asking, does the book address the art of portfolio management?
Absolutely. I mean, I think the art of portfolio management comes down to the first factor, and that is what is the regime that you're in. And you can't construct a viable portfolio, I believe, unless you understand what regime you're taking place in. So the book is broken into 3 parts. Is it David who asked that, Jeanette?
Yes.
Great. So David, the book is broken into 3 parts. The first is regime recognition. The second part is strategy creation, and the third part is implementation. And as you're constructing your portfolio, as I talked about with Hima's presentation in the last hour, you need to have an understanding of what works. And for me, true portfolio construction and true non-correlation understands how each strategy correlates and relates to that underlying market regime. What a lot of people, and where I think risk parity models can come into play, because there's a lot of risk parity portfolio construction out there, is risk parity really plays well in a lower for longer interest rate environment. But then what happens when your long duration, your long bonds, your long equities, and the Fed begins to go on a hiking cycle? So whereas risk parity and a lot of portfolios benefited from a lower for longer cycle, they're going to struggle, I believe, as we've seen the struggle in fixed income in the last 2 weeks when we enter a different regime. So the first question about portfolio construction has to be about the regime. And when it comes to the regime, we cover that comprehensively in this book.
Okay, all right. Next question. Hi, John. Paul here. We emailed the other day regarding mentoring in 2018 after I've read the books, which I already have. Should I take this course or wait until January? Yes or no?
Absolutely.
Do both or wait?
Absolutely. This is why you take the course, Paul, because it's with TradeThirsty that I am doing the only premium content webinar of 2017. Okay, I make 100% of my P&L for 100% of my living from my trading P&L. Okay, 100%. All right. I don't do webinars. I don't do paid webinars. This is the only one I'm doing in 2017, and I'm only doing it with TradeThirsty. So anytime you have a chance to acquire this information that I'm sharing, frankly, it costs me too much money to do it more often than this because I'm trading the markets. So hell yeah, sign up.
All right. He said hell yeah. Okay. All right. After the two Wednesday courses recorded? And I know the answer to that. William, yes, we will record everything for John, and we're going to store it for him, and we're doing all that back-end stuff for him. So yes, the recordings will be there, and you'll have a gateway to go see the recordings and to have your downloads and everything. In the performance of a strategy, how much do you risk per trade?
That's a whole other question, and I believe in, and I size my trades based on confidence interval, and based on some other factors as well, but that ultimately go into that confidence interval. So I'll look at something, I'll size up as much as 5% of the portfolio if the confidence interval is there, but then how I size and then how I structure is another question as well. So I can structure it through options, I can structure it through spreads, I can structure it through a number of ways. So at the point of at the risk of not being direct, there's a bespoke or idiosyncratic or customized or unique aspect to every trade. and the uniqueness of that trade will determine the sizing that I have. But what's important to note is that in chapter 21 of the book, I talk extensively about risk budgets. And, the phrase maximize return per unit of risk means that every investment you make must be measured against a budget. Whether the budget is, there or not, that's really what has to come into play. So for me, the risk budget determines ultimately, how I structure all that stuff.
Okay. How does your approach differ from or incorporate the market profile approach, which identifies value areas and POCs?
To some degree, I have a lot of respect for market profile. Bill Glenn, who wrote Chapter 9 on fixed income, goes into some market profile there. I'm a big believer in buyers and sellers. I'm a big believer in Fibonacci. I'm more of a hardcore Fibonacci guy than I am market profile guy, but I have a lot of respect for market profile, and I collaborate with a lot of market profile guys. And to me, it's like a confluence factor, or I think the term I heard from Tony earlier was synchronicity in terms of Fibonacci, but synchronicity can also apply to other technical factors as well. And so if I have a market profile guy telling me, hey, listen, this is a value area here on fixed income, and I have a fib level there, and I believe that there's a market position premium or discount, then I'm going to maybe take a long trade, okay? But to me, that qualitative market positioning aspect really enhances your market profile analysis. And again, as you ask your question to take this course, or to take any course, whether it was Tony's, whether it was Hima's, this is the question you should be asking, and this is the game you have to play, I believe, to be a successful trader, all right? Is what I'm going to do going to take me from being a 52% success rate to a 54% success rate? And if I can get, instead of making 30 ticks on my average winner, can I make 32 ticks on my average winner? And instead of losing 25 ticks on my average loss, can I now only lose 24 ticks on my average loss? For a lot of people, that incremental gain, when compounded over 200 trades or 300 trades or a year, is the difference between being able to spend your free time with your family or have to have a full-time job and only trade part-time. So ask yourself in this course, what are these incremental gains worth? And will those incremental gains help me go to the next level of my trading? And this is a question you should ask for any course out there, not just mine, but for any course. Is the $297 worth the incremental gains? And let's just speak real. If you don't like this, you can turn around and sell the Global Macro Edge on Amazon, because how many used copies are on Amazon right now? There's zero. You can put this book up there for $130, in 2 days someone's going to buy it, because nobody sells their used copy, okay? I'm a big BMW fan, or a big iPhone fan. If you went and bought the new iPhone 8, you could still get about half the price for the iPhone that you bought 2 years ago, because they retain their value. There's a real market. There's a real value in that, okay? So in all actuality, if for some reason you hate me and you find no value at all, you're still talking $150 risk, or $170 risk. You can flip around and sell the book you want and go from there. Just a little, heart-to-heart numbers assessment. I'm kind of a numbers guy, as you can tell. The next question I see here, Jeanette, do you mind if I go and read the questions?
No, go ahead.
Okay. So with so many trading books on the market, how is this book different? God, you asked the right person that question. So listen, it's because there are so many trading books on the market that this book is actually, I think, even more essential, all right? But the first thing that defines this book is the filter mechanism, the Netto number, all right? What this book does is allow you to take a three-dimensional context to looking at market performance and looking at your own performance, and that's through the Netto number. So here's what I mean by that. I think we would all agree that if I gave Jeanette, okay, $100,000 to trade, all right, and I said, all right, Jeanette, I'm going to give you 100 large, okay, but if you lose $20,000 of that, I'm going to pull your capital. All right, you're done. Okay, I'm going to take it away. You have a $20,000 risk budget, but girl, I want you to go for it. Go for it, Jeanette. Do this. Okay?
Okay.
Now, I go ahead and find another trader, and I say, all right, here's 100 large. Here's the same $100,000, same time frame, 1 year, but you have $40,000 of a risk budget, okay? At the end of the year, Jeanette, she did well. She made me 15%, okay? The other guy made me 15%, all right? Well, guess what? Their performance is not the same. And why is that? Because Jeanette had half the flexibility to work with. Jeanette had half the risk budget. Jeanette's performance on a return per unit of risk basis, holding volatility to be equal, was actually better than manager B. And why is that? Because her risk budget was half the size, okay? So that's just a very basic example. But what the Global Macro Edge does, and why it's different than every other trading book out there, I believe, is it gives you that necessary context to contextualize performance, to contextualize market positioning, to contextualize your P&L. And it does it because there's a three-dimensionality. And that three-dimensionality is incorporating the size of the risk budget before the investment was made, okay? And there's just simply no institutional metric that does that. And this whole book walks you through that process, and your ability now to invest or ask about performance, to talk to a hedge fund, even set up your own hedge fund, is markedly changed, okay? Can I get the next question, Jeanette? Is that okay?
Yeah.
Cool. All right, so the second question is, are you an HFT trader? Am I a high-frequency trader? Well, I'm kind of a high-frequency talker. I can tell you that, okay? No, listen, I rely on automation. Chapter 20 of the book is called, impact, the impact of automation. So I rely on automation, but I'm a click trader, and I use my mind, and I piece together, this mosaic of inputs, and based on that mosaic of inputs, I trade the markets, and like I said, 100% of my trading income comes from what I make from my trading P&L. And that was, great in 2013. That was pretty crappy in 2014, because with my expenses, if you're not making a certain threshold, you're not eating that steak dinner at that 5-star restaurant, I promise you, okay? If you are, it's the meal tastes that much sweeter. So I do live and die with my P&L, and I support my 11-month-old daughter, my wife, with my trading P&L. So I'm speaking from the heart, everyone. Okay, it took 5 years to write the Global Macro Wedge. Tell us about the contributors to the book. Okay, so yeah, listen. There are 14 contributors to the Global Macro Edge. It's a real compendium of great authors. My mentor, Jason Roney, does a great chapter on market regimes. Bill Glenn, like I mentioned, wrote Chapter 9. Denise Scholl, Chapter 19 on building intuition infrastructure. Bob Savage, who was a top dog at Goldman, writes about identifying blind spots in your portfolio. Neil Azus, who writes the Global Macro, or writes, Sight Beyond Sight newsletter, phenomenal. Talks about how to use the three-dimensionality of options to trade the macro narrative. Pat Heminger goes into relative value and spread trading. These are all people I work with. These are all strategies that I use. These are all things that I incorporate into my process. These are all outlined extensively in the Global Macro Edge. Can you explain some of the charities and why you're so passionate about service dogs, etc.? So listen, I talked about earlier, Rebuilding Warriors. I encourage everyone to, just Google Rebuilding Warriors. You'll see Jeff Anderson. You'll see who they are. They donate about 20 dogs a year. We've given them $5,000 so far, which has helped place 5 service dogs with people. And then we've given, like I said, $3,000 to local charity here, Red, White, and Blue Dog Tags. They're going to be at the Las Vegas Traders Expo here on November 2nd. For any of you who are going to be there, I'm going to have a chance to meet Jeanette in person for the first time in many, many years at this Traders Expo. We'll be doing that as well. So I hope that you guys get a chance to come out. But those charities just do amazing work, have incredibly low overhead, a lot of volunteerism, and again, like I said, to whom much is given, much is expected. God bless our veterans.
God bless them.
Jeanette, you want to maybe take the lead here?
Let's see. How long will it take to read the book? Dave's asking, how long will it take to read the book and start to implement the strategies?
How committed are you to the process, Dave? I think reasonably, this is a book that you want to read 4 or 5 times. This is a book you want to highlight. This is a book that you actually want multiple copies of. One that you have at your trading desk, one that you have in your library, one that you have in your car, one you have near the toilet when you're going to the bathroom. Like, seriously, you want to be reading this and absorbing this information, because it took me 5 years to write, okay? I think reasonably it's like a 3 to 6 month deal to absorb, all right? And it should create only more questions, but it will expand your market IQ. It will challenge, because what I do in this book is I take the 6 biggest myths on Wall Street, okay, and I freaking turn them on their head. All right, the first biggest myth on Wall Street is, more risk equals more return. Bah, wrong. More risk equals more risk, everyone. It's smarter risk that equals more return. And I outline how that's possible, okay? The second myth out there, money always finds its most efficient home. If you guys all believe that, you wouldn't be here on a Saturday morning trying to learn to get better, because the market is not efficient. Chapter 3, you can read that on the Look Inside feature on Amazon. I talk about how the market's not efficient. How's the market efficient if I can take $100,000 in 6 years and make $3.1 million in P&L, audited? Okay? No, not true. All right? Number 3, emotions are your biggest enemy. Wrong. Emotions, and this is gonna generate some eyebrows, raise some eyebrows. Emotions can be your biggest ally. And that's what Chapter 19 is about, building an intuition infrastructure and me using my emotions, me using my intuition to help understand market position, to help understand these trades, okay? The fourth thing, diversification is the only strategy you need. Well, I got a question earlier about portfolio construction. I think we're going to show you that diversification can work for and against you. You know, what today's diversification is tomorrow's correlation, all right? The fifth thing, there were more opportunities in the past than there are today. Actually, I think because of people like TradeThirsty and the technology that's out there and the information now that we have, the Netto number, I think there's never been more opportunity to a more diverse group of people. Given the information, what you need for that information is the filter. You need to know how to filter that information. The global macro edge is that filter. And then the last myth of the book that we bust is compensation should be based on returns. Well, that makes sense, John. If I make X, I should receive X. Wrong. Compensation should be based on returns per unit of risk. You shouldn't make, going back to Jeanette's example, Jeanette made 15%, but she deserves a higher payout than the guy that made 15% but had twice the risk budget. Do you not agree, Jeanette? Do you deserve a higher payout, Jeanette?
Do I deserve a higher payout?
Absolutely. Jeanette always deserves a higher payout because she's
always. What? I'm a warrior in my own right over here.
So Jeanette deserves a higher payout always and every time. So I teach you how to construct that payout. I teach you how to use the Netto number to not only assess the performance of a strategy, but the performance of a market. And then once you have that, I built a risk factor compensation system, which is all explained in the Global Macro Edge, to then give you a scale that based on one's Netto number, so Jeanette might earn, you know, a 22% incentive fee, where the other guy would only earn a 15% incentive fee. But Jeanette did a better job maximizing return per unit of risk. So I show you how to analyze that. And I show you how to build that out, which is why so many hedge funds have bought this book, which is why so many RIAs, self-directed investors, people who want to take control of their portfolio and are sick of paying fees and without having any viable alternative. Next question, please, Jeanette.
Hey, yeah, this question keeps popping back up. So what sort of strategies can you incorporate market positioning analysis with? Is it just counter trend trading?
Great question.
A couple times.
So not only does market positioning help you with counter trend trading, but it helps you with relative value. It helps you with trend trading itself. If you get a trend signal on a market that's trading at a discount, that market has a higher probability of reaching your more extended price targets because it's along where the market's pricing in bad news. So if good news comes out or this strategy works, the market gets caught offside, you end up catching a bigger price target. Conversely, if you get a trend signal, a trend following signal where the market has traded at a premium, okay, you're less likely to reach that price target. So you want to manage that more accordingly. So this not only helps counter trend traders, but it helps trend traders as well. And this is how you get the incremental gains. You go from a 52% winner to a 55% winner or a 56% winner. I live in Las Vegas. You want to know what the edge is the house has on craps? 52%. Okay, 53.5% on blackjack, depending on the game and depending, you know, some of the basic strategy you bet. Okay, depending on what strategy that the player uses. But these incremental edges the house has, they've made billions and billions of dollars on incremental edges. So it doesn't take much to go from a trader that's struggling to break even to a trader that's now consistently making money. Maybe not, you're not, you know, it's not bottles and models, but you're making money. I don't make bottles and models, but I make money to support me and my family. I get to go down every morning and spend time every morning with my 11-month-old daughter. We have a Brazilian-speaking nanny, you know, from Brazil, a Portuguese-speaking nanny from Brazil. I speak Portuguese with my daughter every morning. I can do that because I understand market positioning. What's that worth?
John, Sam is asking, any prerequisite market knowledge for taking this training session? If I'm just starting in the market, will this be too advanced for me? Thanks.
Sam, I take it upon myself that this is a course that I made very digestible so that the beginner, person like yourself, or someone who's just, establishing a methodology can benefit from, and a person who is experienced can stand to benefit from. I would say why it's even more important for someone who is starting to sign up for this than even someone who's more experienced, while it's beneficial for both. If you start off with an understanding of market positioning, you're going to pick up an incredible amount of time on those who've been at this game for multiple years. So if, let's say, you sign up for Hima's course from before, and you incorporate her momentum strategy, and you already have an understanding of market positioning, I just think it's going to accelerate your learning curve, and it's going to put you in a much more desirable spot, and why it's even more important for people who are beginners to understand market position, because at the core of it, it's about buyers and sellers, sentiment over who's buying and who's selling, and what that sentiment is. And then when you understand that sentiment as a beginning trader, it puts you in an incredible position to prosper.
All right. How long did it take you to become a professional trader?
Honestly, I'm still becoming a professional trader. and everyone, that's the truth. The learning never stops. I learn stuff every day. I seek knowledge every day. I seek people every day. You know what I also love about this course is that when I wrote this book, I had to crystallize all of this stuff. I had to memorialize all of this stuff. And in the process of memorializing this in a way that people could read and to make it digestible, and I would love anyone who's actually read the book that's on this seminar. I've got a few notes. I would love some comments and testimonials here to share your experiences about this book and what you've read and why there are no used copies available on Amazon. Share with some other people about what you've done. But for me, the development continues. I learned things this week, every week I set up a list of vulnerable market positions. I set up a list of biggest market positions. And I'm always trying to invent new ways, trying to always stay ahead of the curve, trying to get better. And that's a learning process, And I do things from time to time that I say to myself, that wasn't so professional. And so for as robust and rigid as my process is, and I have a very rigid process, I make mistakes. I do things that aren't professional, but that's, that happens. But that's for many, many years now, many years. And I say it all goes back to when I was a bookie in high school.
It all starts back with the booking, right?
Yeah. Making markets on sporting events. Speaking of college football Saturday, we got some kickoffs coming off here soon. So, yeah.
Hell yeah, we do. Hell yeah, we do. Okay, do me a favor real quick, John. Go back to the letter. Take your slides and go back to the auditor's letter for just a moment.
Yep. 1 second, please. Sorry.
I think it's way back at the beginning, I think.
Oh, yeah. There we go.
Okay. So there's been a couple of questions about if you're making money in marketing or you're making money in courses or trade rooms, or you making money in your trading. And I noticed that people came in after we got started, so they didn't get to see this letter that basically goes and says that your track record is solid, that your trading performance is solid, audited. And so I just thought it would be important to go back and share this real quick and to make the statement that, for me, that's what I do. I help traders that are out there that are really good, that I feel like I should bring to the forefront. I bring them into TradeThirsty, into these events, and share them with y'all. But John, I haven't had any work with John, and and even then it was just like this. He came on and just chatted up a trade room I was running at the time. He's not running a trade room, or he might start his service back up, but he's not making money off stuff like that. He's making money, not even off his books, right? He's showing you where he's giving all that money away. And God bless him, over there shipping them himself. He sent me a book. I had it within 3 days. It came in this beautiful box, all bubble wrapped, and I've got it sitting right here on my desk, and it does weigh as much as a medium-sized child, small child. I guess maybe a little child. It feels heavier than a 5-pounder, but it's a big book. So anyway, you can go back to the end now. I just wanted to have that thrown back up.
So something, and I think it's important to get in this, and I pride myself on my transparency, is that it's not been a smooth road. If we look at, while we're there, let's go over my track record here. Let's get to where there was, some losing months, and one in particular. And I talk about this in the book because I think that, this is the real world, okay? And I'm constantly pushing the envelope, which is why, if you look at 2015, my performance in here, whoops, sorry. Sorry. How do I get the cursor so I can show? Can you see my mouse on this, Jeanette?
I see your mouse, yeah.
Okay, great, perfect. So you can see, April I popped 97, May 127, June 126, July 180, August 92. I dropped 21,000 in September, but I blow through $180, in October. This freaking hurt. Okay.
That was when you were supposed to say, Jeanette, I'm taking you off the table. You can't trade anymore. You need a Jeanette break. We'll call it the Jeanette break.
That's a Jeanette break right there. No, that was a Netto break. That'd have been nice to have a Netto break. And honestly, I came into a market, and this was actually a time which even helped, further crystallize my market positioning. I believe that the Fed was going to downgrade its forecast. I talked about this on a couple other interviews in the past because everybody goes to this loss and talk about when you dropped $180,000 in the month of October, John. How did that happen? And it was a volatile month in and of itself. I had a lot of big P&L swings that month. As the market was heating up, there was some differing views about central bank policy and guidance. And I came into the Fed decision that day, long gold, long fixed income, really just short the dollar, thinking that the Fed was going to have to drop based on some previous labor estimates. The Fed was going to drop their, the language in their statement about the labor market being off. And I was actually correct about that, but what they also did in their statement was more or less ensure there would be a December rate hike for the first time in 8 years. And the market wasn't ready for that. And that day I lost a lot of money, betting wrong on the Fed. I've made a career betting on central banks. I made a career betting on banks using my methodologies. Obviously, even in 2015, pressing my profits higher, lost money there as well. I didn't like it. It didn't feel good. It was pretty crappy. Struggled in November, made 15 and lost another 49 in December. 2016, back on the horse again, while obviously the audit went to the end of 2015, but 2016 was another career year for me, really solid stuff. So we obviously eclipsed that and made new P&L highs. But that October right there was a rough month. But, I was more than willing to I was trying to make $300,000 or $400,000 that day, taking the profits I was up on the year because at that point in time I think I was up 650-ish on the year. At that point, 650 to 700. And I thought on that day possibly, or that, following that, I could be up over $1 million, And I'm not afraid to press profits when I believe I have a demonstrable edge, and I thought that I did. I made a few mistakes. I learned from those mistakes. And like I said, I'm still developing as a professional trader, and that's an example of that. And that language, that humility, is articulated in the book. And I'm very open about my losses and what I've learned from those losses.
And not many people, they like to talk about the gains, but they don't like to talk about the losses. And to me, it's more important when I have a speaker on here, it's more important for them to talk about the losses because those losses are what you learn from. I mean, nobody's standing around pissing and moaning when they're making money, right? When you're making money, you don't really get and you should be laser focused on when you're making the money, how you're making the money. Instead, they wait till they lose money, and then they're like, oh crap, I got to go focus on this. What did I do wrong? What did I change? And sometimes it's not that you changed many things. It's just the market is what the market is. You just got to stay.
Noise happens, randomness happens, and that's right. Part of the process is embracing that. And I mean, the bottom line is this: 100K made 3.1 million. No correlation to the S&P. You can read about it in the Amazon Look Inside piece. I mean, it is what the track record speaks for itself.
So a question we have on the board: are you currently long gold and short fixed income?
No.
No on both. Okay, roughly, how does your portfolio break down between futures, options, stocks, ETFs, currencies? Is there a certain market you?
I largely trade. Again, I'm a cross-asset class, high-velocity cross-asset class futures trader. So my portfolio is comprised of strategies, not long-term macro positions per se, because I believe in this market that longer-term portfolio construction is going to be challenged, and I'm much more tactical. I rarely hold positions past a week, and I think that the nature of this and the changing narratives being what they are, and the relatively low volatility we've had, there's lots of opportunity as measured by another ratio that I talk about in Chapter 5, the opportunity ratio in this market. So a lot of what I do is, the genesis of what I do is put together a basket of strategies and what I call a UOR strategy grid, or a unit of risk strategy grid. I talk about the strategy grid in Chapter 8, and I talk about it in Chapter 5 as well, where I literally will grade out what the implied netto number is of these strategies going forward. And so these strategies are by definition they're market agnostic. And so, I say, okay, how well will my mean reversion strategy work in FX today? How will my trend following work in gold today? How will my relative value work between European and U.S. fixed income today or this week? And then I incorporate that in. It's a very comprehensive process which the book gets into, and which is why even this market positioning side is one nugget, an incredibly important nugget, an essential nugget. But I have 20 years of trading experience that I put into this book, So when we go into this course, some of it by definition is just unscripted, which is why even if you have the book, you should sign up for this, because I just spout out knowledge that just comes to me as a natural course of sharing stuff. But to the portfolio question you asked, I run them based on your strategy grid and based on what the market regime is. And so I'm less thematic in the sense of, I think you should be long gold because growth is going to do this and that. I do think we've had a major turning point in fixed income. And so in that regard, I think that selling balances and putting in place strategies that take advantage of, balancing fixed income and a steeper yield curve is really what you want. I think the Fed is going to hike in December, and I think some more hawkish rhetoric is coming out. And I think that even maybe the euro to some extent has some vulnerability. I think the British pound has some vulnerability against the dollar right now, and emerging markets as well. So I'm constantly balancing that act. And given my balance sheet as a professional trader, and this is what I would tell people out there. I get asked this question a lot, Jeanette. I'm going to answer it here, even though it wasn't asked by that first question. And that is, your portfolio should be representational of two things. One, your skill set, and two, your balance sheet, okay? If you have a trader skill set, you probably should not be constructing a longer-term trade portfolio like that of $1 billion person. In other words, take your biggest weakness, which may be a lack of capital, and make it your biggest strength, okay? And so your lack of capital means that you're unlikely to face liquidity constraints getting into or getting out of a strategy, all right? I don't really face liquidity. If I want to sell 100 Treasury future contracts, I'm not going to face any liquidity from that. But if I want to sell 10,000, like maybe $1 billion fund wants to, they have to take a different tactical approach and a different time horizon. So the portfolio that I construct is based around my balance sheet and my ability to maneuver and be tactical in a market. Sorry, I got a little hiccups there. Next question, Jeanette.
Okay. Will they learn the Netto number in depth in the course?
The course is about market positioning. The Netto number they will learn in depth in the book, which comes as part of the course. So you will get a lot of information on the Netto number as covered in the Global Macro Edge. It's featured extensively in the Global Macro Edge. So, and I'm even open to, if you have a question about the Netto number, I'll answer it in the market positioning course. All right, but the market positioning course was really about understanding market positioning, because that's something you can apply. But the Netto number is also something you can apply. And maybe I'll talk with Jeanette, because again, I can't let this interfere with my trading, so I can do these premium webinars on a limited basis. But maybe in 2018, Jeanette, if it's okay, we'll talk about a Netto number course, because I got to space these things out. I have to focus on my trading.
Right, I got you. All right, so we're gonna wrap it here, unless you have any final things you want to say.
Final things, you got to order the book in now 45 minutes for us to pack it and ship it out, and to get out with the Saturday. We're going to use the benefit of the Pacific time zone to get this thing shipped before noon. So we have to have it in the next 30 minutes, your order, so my wife and I can pack them between 10 and 11 Pacific time, and then get to the post office and send those things off. Okay.
Right, and I will make sure that you have all the information that you need, and we are getting close to our 23 for today. So you guys, if you're going to buy, you better buy now, because I'm about to send him the list, and he's going to go into Amazon mode over there.
Exactly.
All right. Thanks, John. Thanks for your time today. I appreciate you. And
thanks so much. Thank you, everyone. God bless our veterans. Thank you.
All right. God bless our veterans. Thank you, John.